Prashant Jain joins us, Executive Director and Chief Investment Officer with HDFC Asset Management. Prashant, what is the real global picture according to you? Because we've been endlessly arguing about slowdown and recession now.
I think, Nikunj, these are things, that's why sentiment is so hard to forecast and things change quite a bit. And who would have thought that what is happening in Ukraine will happen? And that has led to a sharp spike in commodity prices. It has increased inflationary pressures, and clearly the rest has followed. And that's why we always say that equities are extremely hard to forecast, very risky over short to medium periods. So I think where are we? I think inflation is here. US bond yields have gone up by almost 2.5%. Indian yields have also moved up. Markets have come off, and excesses in the markets have corrected. If you look at the Indian context, markets have been now broadly flattish for between 1 to 1.5 years. And this is a reasonable period for an economy which has grown in high single digits last year, add to that inflation. So that means in terms of nominal GDP, the markets have underperformed significantly. So I think as I see the outlook for Indian economy, for corporate profits in India, is steady, and I think there is some value that is beginning to emerge now in the markets. And because a flat markets for 1 year leads to 15% lower market cap to GDP. So I think I am a little more constructive than what one has been in the recent past years.
So what makes you positive on the market when interest rate cycle is against us? If interest rates go higher, it will have an impact on the underlying valuation and the asset classes will get repriced.
And I think, Nikunj, that's a very fair question, and I think there are two things I would like to say here. See, even in the past, if you look at the history of Indian capital markets, we have seen interest rates at higher levels. Even US 10-year yields were quite high until some time back, especially pre-Lehman. And even in those times, our markets used to broadly track the nominal GDP or the profit growth of the country. So I think interest rates are an important factor, but I think over time, and this we have discussed in the past also, over time, growth dominates, or returns are more determined by underlying growth and less by interest rates. Coming to corporate profitability, I think the impact of rising interest rates might actually turn out to be positive in India, at least for the time being, counterintuitively. And that's because almost a third of the profits of Nifty in India come from banks. And banks, the way they are positioned today, bulk of the loan book or a large portion of the loan book is floating. And therefore, a rising interest rate environment should help NIMs. And we are also seeing credit growth picking up. While many of us believe or feel that rising interest rates should lead to slower loan growth and vice versa, I don't think things work out that way in real life. If that was the case, then last few years interest rates were so low, but loan growth was also quite low. So I think credit growth is more a function of how the economy is doing, how are demand conditions, how is capacity utilization, how are the balance sheets and cash flows of companies. And I think today I feel that with every passing year our credit growth should improve, and rising interest rates of course are good for banks. Bulk of the other corporates are substantially deleveraged. The corporate leverage in India is at a 10 to 15 year low. So I think the impact of rising rates on profitability in India should be quite muted for quite some time. In fact, many cash-rich balance sheets will earn higher other income if interest rates go higher. Coming to the second impact of interest rates, and that's on multiples. Yes, cost of capital goes up, so it should bring down the fair multiples. So I think, but today what has happened because of this long time correction in Indian markets, valuations are looking quite reasonable. The outlook for profit growth is quite decent. Corporate balance sheets, bank balance sheets are extremely healthy. So I think even if you work with reasonable multiples, I think we are at a level where next few years or over the medium to long term, I think returns should broadly track nominal GDP growth rates.
But what about the compulsive part, which is that a deleveraging has started in crypto? The deleveraging has also started in a lot of other asset classes. Technology stocks have taken a hit. Don't you think this, in a sense, could have a snowball impact on all other asset classes? And because of the connected world we are in, that could also impact emerging market stocks and Indian stocks?
I think, Nikunj, we have already seen quite a bit impact of that. If you look at FII selling last year and this year, it is now touching almost 30 billion US in just year till date. And I think that was probably, some of it was anticipatory selling in expectation of US yields moving up. So I think to that extent there has been some impact. I think the broader markets or the pockets of excesses have had far deeper corrections in India and outside India. And we have seen time and again that when the operating environment or the environment for capital markets becomes slightly more difficult, the excesses tend to go away quite fast. And I think we are experiencing that phase. But fortunately for us, the Nifty has held up extremely well, driven by substantial local flows. And as I said, the valuations out there are looking a lot more reasonable. Banking has corrected, technology has corrected. These are very strong sectors with large index weights. So I am not saying that markets will go up from here or they can't correct more, but I do feel that over time, as strong growing businesses are now available at reasonable valuations, I think the risk reward is looking better today than what it was looking a few quarters back.
Let's understand the impact of inflation. How will this change underlying valuation? Because you typically like value stocks, where inflation will have a very large role to play. A sector like power, sector like cement, even for that matter, banks. How does inflation change value investing?
So Nikunj, you are right. I do avoid excessively valued sectors, and I think that has held us in very good stead over time. But coming to inflation, see, equities are a hedge against inflation. It is the bond investor who should really worry about rising inflation and therefore rising cost of capital. And if you look at the composition of Nifty's profits, as I said earlier, 1/3 of profits are coming from banks. Inflation goes up, interest rates goes up, it is actually not negative for banks. Roughly 1/4 to 1/3 of the profits of Nifty are coming from commodities or commodity types, like refining margins, etc. There again, the elevated commodity prices, the elevated refining margins are positive for that 1/4 to 1/3 of the market. About 15% of the market or profits is in pharmaceuticals or utilities, etc., which again is broadly not impacted by inflation. So the only place where inflationary pressures could hurt margins or demand is the consumer space in India, both the staples and the discretionary. And that is about between 10 to 20% of the profit pool of Nifty. And over time, even there we have seen that these companies will pass on cost hikes to the consumer, maybe with a lag. So I think the very nature of the equities is, one, they offer you a hedge against inflation because these are priced on to the consumer, higher prices, and specifically the composition of Nifty profits is such that it sounds very counterintuitive, but inflation will actually probably lead to some earnings upgrades and not downgrades.
Let's get a very basic question answered here for our viewers. The asset allocation which we often talk about, asset allocation is the 80% reason why you want to create long-term wealth. Would you say the tilt now clearly has to be go long equities, more biased towards equities?
So Nikunj, I would again come back to what I have said earlier on a number of occasions. See, asset allocation should be driven more by individual situations and risk appetite, and whatever is your risk capital, meaning what you can spare for long periods of time, where you can tolerate volatility emotionally and financially, that we should invest in equities. And the other part, I think we should invest in fixed income. In fixed income, I think as interest rate bond yields have moved up, while if you have invested in duration funds some time back, the returns in recent past are indeed looking low. But then I am sure many people like me have been advising against buying duration in a low interest rate environment. I think now interest rates in India are at a reasonable level. I am not saying they can't move up higher, but I think it will start making sense to slowly start building duration in the portfolios, even in that safe portion of capital. But of course, you again have to take a few years view, because 10-year is now between 7.5 to 8. This is a reasonable level, I would say. Yes.
Your tilt towards, let's say, energy. You own NTPC, you bought PFC in the past, you bought Coal India in the past. These stocks were very cheap. But given where the energy cycle right now is, there is a chance that energy consumption will come down. Inflation will have impact on some of these asset classes. Do you think the uptrend which you spoke about last time when we met, about why you bullish on energy as a category, as a cluster, is the cycle, has that view changed?
So Nikunj, you are right. My funds have been overweight these spaces, and I think the outlook continues to be reasonable for this space. The banks, as I said, are well set, rising credit growth with a scope for margins to improve, very low NPAs, so provisioning costs should be quite low. And I think the digitization or the move to digital banking will support larger banks. So I think the outlook there is quite decent, and financials have also underperformed sharply because they are the most owned by foreigners. So they have also borne the brunt of the FI selling. So financials are actually looking quite reasonable. Of course, if the selling continues, they may underperform for some more time. Coming to energy, I am sure everyone has observed what is happening in the energy space, and I think this is what we have been saying for a while, that the energy space offers sustainability. It offers growth because India's energy demands will continue to rise. And I think the valuations, while they have moved up meaningfully from the lows, I think they are still offering reasonable value. So I think there is merit in remaining invested in this space, though clearly as prices move up, the incremental merit keeps on reducing.
When we met last, your view was that large cap stocks they offer better value than mid cap stocks. But now mid cap stocks have corrected. In fact, in Nifty has not corrected and large cap stocks have not corrected. Is it time to look the other way now?
So Nikunj, I mean, you are partly right, but I mean, just to tweak that argument a little, I think it's better to say that leaders or businesses that have competitive advantages, whether they are mid caps or large caps, depending on the industry, I think they offer better value. I mean, better risk adjusted returns, or that's what we have seen. You are right, in this fall, the small mid caps have fallen off much more than large caps. And this is one reason why I have said that the most portfolios should have a tilt towards large caps, because they offer similar returns over a portfolio as compared to small mid caps, but with lower volatility. I would still, I mean, while small mid caps have corrected, but I think the first round of investments, in my personal opinion, should go towards large companies, large funds, large cap funds, because that's where there is liquidity, that's where the risk is controlled. It has been a very resilient sector, and maybe when markets stabilize and some liquidity comes in the small mid cap space, I think we can look at that space. I think the amount of stock that has changed hands in large caps is far more than in the small mid cap space. So, I mean, I could be wrong, but I do feel the selling pressure, or those who want to realign their portfolios in the small mid cap space, I think that remains. So I would round one probably prefer large caps. Over time one could allocate more towards small or mid caps as well.
Prashant, what looked like a complete bull market and a bull market like never before, now perception has changed, view has changed, and it's very overwhelming to see that suddenly your SIPs are giving negative returns. How does one deal with this kind of a dilemma where you know that whatever you've invested in last couple of months have not given you returns, and even fixed deposits are giving you better returns?
See, I think, markets like these, they always take the excesses away, and you can see how the narrative is changing. The narrative towards crypto, the narrative towards many new age businesses, the narrative towards some very, very high PE companies. You can see how those valuations are correcting, and those who had not experienced the cycles earlier, I think they would have probably been on the wrong side of these markets. I think they should take this as a learning. I always joke that it's good to start in equity markets with a little loss, because it prevents you bigger mistakes on bigger scale subsequently. So I think these excesses are going away, and these markets, I think, will be more rewarding for the investor who follows the simple principles of investing, invest in good quality businesses, focus on reasonable value, and remain diversified. And if people have not made money over a 1 year period, I don't think there is anything to worry, because equities are not a 1 year asset class. The equities, the best returns come over much longer periods. And in equities, the other good thing is that your returns are never lost. If businesses keep on growing and markets don't grow, then you will get to those returns at some point in the future. And that is how Sensex has compounded at such healthy levels over long periods of time. So I would say that those who are savers, those who have the risk appetite, they should start increasing exposure towards equities. But of course, they should avoid futures and options by and large, to my mind, unless they are really experienced, they know what they are doing. They should remain diversified. and they should, in at least in my opinion, focus on quality and value, or alternately they can focus on mutual funds. Yes.
Just wrap it up, Prashant. I mean, I'm sure it's a great feeling when you suddenly see, not suddenly, but it's a work in process and it's in thought and it's a strategy which you've adopted, that your schemes are almost in the top quartile. I was looking at the top quartile category for 1 year, 3 year, 5 year. HDFC schemes and some of the funds which you manage are right up there.
No, Nikunj, it feels quite good. We are relaxed, and because not few quarters, but slightly longer than that, funds had not done well. And I think our positioning in the corporate banks and power stocks, we were caught on the wrong foot when COVID hit, because these sectors were impacted the most. But as I have said, we are focused on quality and sustainability, and the same businesses that were in pain during lockdown conditions have come out quite strongly, and the market has finally seen value in that space, and that is what has enabled this comeback across our funds.
Prashant, it's always a pleasure to have you on ET Now. Thank you so very much for joining us, and the way you've really broken the markets for us as to where the risk reward ratio is. I think thank you very much. I mean, ladies and gentlemen, Prashant Jain is of the view